Hey everyone, this is Theta Warrior. We're making this video today to discuss some recent activity I've been following in the SPY flow. And I've been tweeting about this and kind of watching this group of traders move around their position. And I've been getting some questions. So just wanted to make this video and kind of walk you through my thinking, how I've been following these trades, and what I think is behind it. So to cut right to the chase, I do believe that this is a hedge for a long position. There's no way for us to know how big the position is or what the position is. All we can see is the flow, is the hedge itself. But doing some math, I can kind of conclude that the position is likely in the neighborhood of 350 million to potentially up to $1 billion, although I think that's a less likely scenario. And I'll explain to you why and how I got to that conclusion at the end of the video, but I want to look at the flow first and kind of show you. So we're going to be looking at the BlackBox stocks flow today. And if you're unfamiliar with BlackBox stocks, I just wanted to give you a quick refresher here. So whenever we see a white line like this on the bottom left, that means that the open interest was not exceeded. If we see a purple, that means the open interest was exceeded through multiple trades. And if we see a yellow, that means the open interest was exceeded in the single trade, in that one trade that we're looking at right there. If we see A and AA, ask side and above ask, generally that's going to mean buying. If we see B and BB, bid side and below bid, generally that's going to mean selling. Now, there are exceptions to both of those, but that's a good rule of thumb. Whenever we see a sweep, that's going to be a market order. If we see a block, good way to think about it is a limit order. It's pre-negotiated. It has, certain parameters around it that need to be met. A sweep is just an aggressive, get me in at any price, type of trade. So we definitely give a lot more weight to sweeps. So that is how you read BlackBox stocks flow. So getting right into it, the first day that I really started watching this group was on Friday, May 27th. And we can see in the morning, they came in and bought the 392 put expiring in July. And we can see this big order right here in the middle. It's yellow, means the open interest was exceeded. So we know that it's fresh buying. It's coming in on the ask. And you can see it's followed up with another one right there, almost 5 million. And basically all of these trades came in within, a minute, less than a minute. And yes, you have a couple on the bid, but they're blocks. And, sometimes as all of these contracts are being put up, the spread is going to shift around a little bit. Maybe a few of these went off on the bid and it made this order come in bid side, but this is all going to be buying, right? All of this is buying. Now the IV didn't move just simply because it's SPY and it's extremely liquid and it's, traded, basically more than any other stock out there. So sometimes the IV is not going to move, especially in such a quick succession like this. So we know that this is buying, right? They came in, they bought, and then we see them later on in the day selling. You see all this below the bid, below the bid, below the bid. Now, normally you would see a yellow and see, below the bid and say, okay, are they writing these puts? Well, we know the answer is, of course, no, because we just saw them buying it earlier in the day. So we know that this is a closing transaction here at the top from the opener that they took in the morning. And you can see based on the timestamps, at the very same time they're closing these 392 puts, they're immediately buying the 395 puts. Okay, so what do we know? We know that there's a trader out there put a lot of money to work in the 392s when SPY was trading 411, call it. So SPY rose to 415 during that day, and the trader took a loss. So they sold these puts that they bought at $8 for about $6.90. And immediately went up 3 strikes to the 395 put. So that's interesting. So they started out about 19 points out of the money with these 392s when SPY was trading 411. They rolled up. Now they're getting, again, in that same range, 20 points out of the money by rolling up to the 395s. So that's important. And I'll explain again why later in the video. But I just kind of want to get through this flow and walk you through step by step. So this was Friday, okay? The very next day, I'm sorry, the following Monday, market was closed because it was Memorial Day. So Tuesday, near the open, we see them selling below the bid and on the bid, about 12,000 contracts SPY dropped. You can see from 415 on the close on Friday, dropped to 410.5. So these puts went up in value. They took $1.50 gain on those puts. So they've trimmed their position essentially. And actually later on in the day, they bottom back. I'll show you quickly here on BlackBox. So this is BlackBox stocks, and we can look at the historical. So that was the 31st. This was the original flow right here that we were just talking about. You see them it comes in all together, 392s, the 395s, all the July expiry. So it's really obvious that they're shifting their position here. And we'll look at the historical. We'll go to Tuesday. So there's the 395s. So what I just showed, these 395s, the two below the bids, these are these two trades right here. Later on in the day, we see the above the ask and the ask for 6,300 contracts. So I believe that this was them buying back their position. They were getting back to their full amount, full size that they wanted this position to be. So we can see now they're net long 22.8 thousand contracts. And the very next day, we see some buying activity actually in the same contract. It looks to me like they bought it back even more to get up to that 25 again. But at 12:01, we see them dump the whole lot. So we see it's all below the bid, below the bid. The big orders are below the bid. The sweeps, again, you've got a funny block that came in there on the ask, but this is all selling. And it's even more obvious when you add up all these contracts and you count it all through, because you can track it all. So what do they do exactly at the same time that they're closing these long 395s that they paid 760 for, the week prior? They immediately rolled down to the 388, all the same July expiry. So they put out $16.8 million into the 388s. We see it's yellow. We know its open interest was exceeded. This time there's no bid side blocks. It's all ask side sweeps. And you can see the big orders are on the top and the bottom there. And again, in this day, they actually added another 4,000 contracts to get back to that roughly 25,000 contract position. Again, sticking in the same range, about 19 points out of the money. So this is key. The fact that they're staying roughly the same distance out of the money, and they're going for roughly, the same amount of contracts in the neighborhood of the same amount of dollar notional value. And that has to do with the delta. And I'll explain all of that at the end of this video. So we know that they're long now, the 388s. So we'll scroll down to Thursday. So, and it's great to track SPY as well. So the spot where it says spot, that's what SPY was trading for at the time of these fills. So on Wednesday, SPY was trading at 407. So the very next day on Thursday, SPY rose to 414, and we see them selling. This is the selling. You can see there was one order that came in on the 392 ahead of them closing these 388s, but we can see that's a 10,000 lot. That's another 10,000 lot, and that's a 5,000 lot right there. That's the 25K. So we see that it's white because obviously the open interest was much higher after they bought it right here. So we would expect it to be white as they're closing, right? Because obviously the open interest is not going to be exceeded if they're closing an open position. So it's that they held overnight. So this is them closing this position at a loss, right? They bought it at 7.8. They're selling it at 5.16, and they immediately roll into the next position, the 392s. You see this ask side 392, 6.7 million. We see another one up here, 4.8 million, 1.1 million. So they're closing those 388s and they're buying the 392s. So what did they do? They rolled closer to the money. Again, sticking in that range, 22 points out of the money. And later on in the day, we see them buy another 5,000 contracts. So they're net long about 30,000 contracts at the end. I'm sorry, at about noon on Thursday. So later on in the very same day, they decide that position isn't working and they sell it all. So they actually bid side out all of the 392s. We can see them selling right here. And all of this is a closing activity, even though, again, you have a couple ask side blocks. This is them dumping the position that they bought earlier on in the same day, because we can see SPY climbed. So originally when they bought these position, the 392s, SPY was trading 414. So SPY rose to 417 away from their, strike. So they closed it. They took a loss here, 55-cent loss. And then we can also see them at the very same time, after hours, again, 4:08 p.m. after hours, we see them buying of the 398 put. So what are they doing? What are they doing? They're continually rolling up closer to the money. This time it's 19 points out of the money. So there's 34,000 contracts shown right here. And we can see the first one came in ask side, it's yellow. So we know the open interest was exceeded. So we know that's all buying. And we see a couple bid side, right? As things can be a little funny after hours. And as well, when they're coming in so quickly, sometimes, like I just explained, sometimes the spread will shift and you'll get a couple bid sides. All of that's buying. You can see it's surrounded by the big above ask sweeps. You got a 7.6 million, 6.5 million. All of this happened, in a minute, basically in a minute. And then you have a couple bid side orders that come in, at 412 and 414. Obviously, all of this came in really quickly. And then there's a 3-minute gap and then another 2-minute gap. It's odd. So there's 3,400 contracts shown. This right here is 31.6 thousand contracts. And it's my opinion. Of course, I have no idea if this is true or not, but I do believe that this is them actually closing 2,500 contracts that for whatever reason they decided they didn't need. Their hedge was already big enough, and they actually sold 2.5 thousand contracts. And I say this because the very next day, which was Friday, we see them selling 29.1 thousand throughout the day. We see a lot of bid side, bid side, bid side, bid side, right? It's all white because the open interest was, it raised coming into this day after they bought it all. And you can see that the math just really lines up. So we've got 31,000, right? 600. They sell 2,500 of them. So the very next day we see 29.1. The math just adds up. They ended up taking a gain on this position because SPY came down. You can see when they opened it, SPY was 417. SPY fell the following day, Friday, and they're taking a profit. So again, we're looking at these trades, and they're taking losses, they're taking profits. 29,000 contracts multiplied by $1.75 gain. They made $5 million that day. The day prior, we just see them, 25,000 contracts. We're seeing them take a $2.70 loss. Oops, I did minus 25,000. 270. So we see him take a $6.7 million loss just on those contracts. They took bigger losses throughout the day. So you may think, my God, that's a lot of money. Well, in reality, to the size position that this is protecting, I don't really think it's a big deal to them. And just to wrap up with all the flow, of course, in true, hedging fashion, what do they do when they close out this position here? As SPY is coming down, well, they roll down now that SPY is lower, 18 points out of the money. So this was the final set that we saw them get into on Friday. And we see this big, massive order come in, 13.5 million, and it's followed by some blocks on the bid. This is all buying, 25,000 contracts, 18 million. It all lines up. This trade happened within 9 seconds. So this spread just moved a little, but this is all going to be one buyer, our whale buyer. And okay, so we'll get into the size of the position that I believe they're looking to protect. So this is 100% speculation. I have no idea how big the position really is, but we can do some math to figure out what it could be. Okay, so we'll roll down here. So this was the last trade that they put on, right? One share of stock is one delta, right? One contract is going to control 100 shares. Each of these contracts are roughly 30 delta. And we know this by looking at the options chain. We can see them. This was, let me see if I can bring this on the same window. Bear with me just a moment. This will make more sense if I can show you here. Okay, so this was the SPY chain from Friday. And we see this is the 398 activity. The volume is high because this is them closing. You can see the open interest was 31,000 because this was them buying the day before. Friday, they're closing it. That's why it's white. And then we see this yellow above ask on the 393. There's the volume right there, 28,000. Maybe there was some follow along sweepers. Who knows? But we see that the important part here is that this is a 30 delta. So that's why I've been referencing that they're roughly sticking the same amount out of the money each time they put on this position. It's my theory that they are trying to achieve a 30 delta hedge. Okay, so let me put this where it belongs. There we go. So a 30 delta hedge. Now, let's just look at two examples. So if they're going to look for a delta neutral, they need 3 contracts per 100 shares, right? Because we just explained that one share is 1 delta. So 100 shares is 100 delta. One contract controls 100 shares, but each one of these contracts is only 30 delta. In this equation, I just rounded up. We know a third is 33.33 to infinity. So just to keep the numbers nice and easy, I just use that as the delta. So technically this is showing a 33.33 delta hedge, but we'll just keep it simple, 30 delta. We see that, they're long 25,000 contracts, which is the equivalent to 2.5 million shares. So you would essentially divide that by 3 because each of these contracts only has a 30 delta. So the position in theory, if they're delta neutral, could be 833,000 shares of SPY. And that would be a value at the closing price of 411 of $342 million. Now that's a completely delta neutral. If they wanted to go on the riskier side and say only buy 1 contract per 100 shares, then the math is just really simple, straight across the board. They're long 25,000 contracts to protect 2.5 million shares, which is the equivalent to just over $1 billion position. So they could be anywhere in this range, 2 to 1, 4 to 1. Who knows what the position, that they're trying to hedge could be. But I believe that it's likely somewhere in this range. And by achieving this, they actually are going to make money if SPY launches and if SPY tanks. If SPY sells off and we get a huge market crash, this position, because of this hedge, is actually going to make money, even though they're long in this theoretical scenario, 833,000 shares. And it's my opinion that they are anticipating a volatile move. That's why they're choosing a 30 delta, because you could easily just hedge your position with 100 delta. You could just buy it in the money put, and it's just a 1-for-1. It's really easy. But I think that this group of traders is basically protecting themselves against a catastrophic event. And by choosing a 30 delta, if they are truly delta neutral, they're going to make money to the downside if that happens, as well as the upside. So they make money essentially no matter what. So let me just get a fresh sheet here and I'll show you, I'll draw quickly a graph of what that looks like, because sometimes it helps to visualize it. So bear with me, my drawing skills here. We'll give this a shot and we'll scroll down there so you can see the positions. Okay, so quickly just draw this graph in. So this is our x-axis, this is our y. On the bottom here, we have SPY. And the price currently is right around 411. I think it's 410.5. On this side of the graph, we have 450. And over here, we have 350. And then on the y-axis, we have profit and loss. Okay. And essentially, if they are truly delta neutral, their P&L graph looks something like this. Okay, so they're going to make money with a SPY moving a large amount to the upside, but they will also make money with SPY moving a large amount to the downside. And I'll explain why right here in this illustration. So first off, it's also important to look at their break even, right? Whoops. So their break even is going to be somewhere in here, right? So basically, if SPY just sits right here, those puts that they're long are going to decay, so they'll lose money. They essentially need their position to increase by a larger amount than they paid for those puts in order for the hedge to, be a non-factor in a move to the upside. And right now, as we already know, SPY is about right there, right? Right now, those puts have roughly a 30 delta. So, and remember, they're long 3 contracts per 1 share of SPY. So in reality, this is actually, I'm saying 100 delta here to be, just keep this math simple, but roughly it's about a 90 delta that their hedge is valued at right here, 90 delta, 90 negative delta, because the put has negative delta. So as SPY falls, right, if it does, I have no idea if that's going to happen or not, this delta is going to become more and more negative up into negative 100 delta. That's the max that these puts can reach. And that would probably be, SPY 375 or 360, something like that. So, and again, keep in mind, these traders are long 3 contracts. So they're actually long 300 delta against their 100 delta, per 100 shares. So what you would do is just take away that 100. So I know I have a minus there, but we're subtracting the 100 from the 300. So their net position will actually be negative 200 delta in the scenario that SPY, rolls over. That's a 200. And so they'll, make a good chunk of money on this hedge. It's going to totally offset any loss that this, long position may take. So that's why I think they are going for the strike that they're going for. And they're essentially, going to be protecting themselves against a large move in one direction or the other. So this is called being back spread when you're net long delta. But it's actually a genius move to do this, because they're only not going to make money if SPY sits. And I don't think anyone expects SPY to sit. I think that we're all either expecting it to rip back up or to sell off here. So I think it's a wise decision. So that's basically what their P&L graph looks like if they are indeed delta neutral. And this is the flow, and you can follow it yourself on BlackBox, and you can actually follow it back even going further than I showed. You can see the first day we looked at was the 27th, but you can even follow them all the way back to the prior week, and they're pretty easy to spot. You just look for like the big multi-million-dollar trades, and you can kind of see, their positioning. So right here we have the 375s that came in. That looks like about the biggest trade. You see some 372 bid sides, see some buying of the 378s. That actually looks like them right there. So we can check by looking at the next day. So that's the 378. So right there, you see them buying on the 523 and then selling on the 524 as SPY went down. So they're taking a profit. And what we'll look for is to see if they roll down. So at the same time that these 378s are being sold, we want to see a buying in something lower, the 375s or something like that. So let's see, the 378s, there's the bid side. So right there is your ask side 373s. So the open interest is exceeded, it's yellow, it's ask side, it's ask side. So this is them rolling down to the 373s. So you see all of that buying right there. You step it forward a day, and you can see on the 25th, they're selling their position. So we would look for them again. Let's see, SPY went back up that day, so they're taking a loss. So they're likely going to be rolling up to a higher strike. So let's see. Looks like that's them right there. Maybe they, let's see, 2.6 million. I can't say for sure because I don't have the timestamps, but that indeed looks like it's them, right? 10,000, 9,900, almost 3,000, 7,500. If I had the timestamps, I would guess that this all happened roughly the same time period, because you can see SPY didn't really move around a whole lot, maybe filled within a minute or two. But this is their MO. This is what they're doing. They're just continually rolling their position. They were in the June expiries during this week. But yeah, so that's my deep analysis on this whale. And I hope that it was helpful and educational. And it's interesting for us to follow along with it, because there is a delta effect. Each time they're going to be rolling a position, there is going to be either a positive or negative delta effect on the SPY itself. So us as traders can utilize that information. And also it's going to be interesting to see, when they get out of it, what does that mean? Does it mean that they took profits on their long position? Does it mean that they're no longer concerned with the downside? There's all different types of conclusions that we can reach from this. So anyway, I'll quit rambling. We'll cut the video right there. You can, of course, follow me on Twitter, and I've been documenting these traders and trying to keep everyone updated as much as I can. When they're trimming out of their long position, when they're getting into the new one, and I'll continue to do so because I think it's interesting and I enjoy it. And I hope that you do too. And I hope you like this video. We'll cut it right there. Hope you guys have a great night. Take care.